Welcome to Global Investment Insights, a weekly podcast brought to you by ADCB Asset Management. My name is Kishore Muktinutalapati, Head of Investment Strategy. With an objective to empower you with investment insights, on this program we discuss various perspectives that are shaping the global investment landscape. We're pleased to present to you our 2024 Outlook series, and in this first episode we discuss our global macro outlook. The year 2024 in many ways is likely to be normal. Pandemic-related distortions to the global economy have largely unwound themselves over recent years, paving the way for 2024 to be the first year of post-pandemic normal. Also, from a growth perspective, we see a more normal year at the headline level, in turn feeding into more normal returns on financial assets compared to the extraordinary years of 2022 and 2023, which saw a bear market and a bull market respectively. However, beneath the surface, that is, intra-year 2024, we expect churning. In other words, as investors navigate 2024, they are likely to encounter twists and turns along the way. All this is likely to create investment opportunities, but also present risks. Let's start at the headline growth level. International Monetary Fund, IMF, expects the global real GDP growth to be 2.9% in 2024, compared with 3% in 2023 and 3.2% expected in 2025, implying a marginal slowdown this year and a re-acceleration next year. However, this masks significant divergence between countries. While the US, Japan, China, and Brazil are expected to experience significantly lower yet positive growth in 2024, other countries led by European economies are likely to experience higher growth in 2024 compared to 2023. Closer home, both the UAE and Saudi Arabia are also expected to post higher GDP growth in 2024 compared with 2023. Moving to inflation, while the IMF expects most global economies to post lower inflation in 2024 compared to the previous year, the fund also expects disinflation to slow down this year. For instance, global consumer price inflation is expected to fall to 5.8% in 2024, that is 110 basis points lower than the inflation in 2023. This is lower than the 180 basis points of disinflation observed during 2023. Here again, while the inflation is expected to fall across the globe, China is likely to be the only exception where inflation is likely to rebound from very depressed levels. Putting these projections into our growth inflation mix framework, we note that the improvement in growth relative to inflation, which began about 18 months ago, will continue. But over the next few months, that improvement is likely to pause as inflation might start to prove sticky at current levels before easing in the second half of 2024. Risks to the disinflation trend present themselves in the form of rising tensions in the Middle East, which have already pushed the transportation charges higher and have further potential to disrupt supply chains and contribute to higher oil prices. Against this backdrop, markets continue to expect significant policy interest rate cuts from the developed market central banks. Worth noting that markets are assigning a 77% probability to the Federal Reserve delivering its first interest rate cut in March this year. Further, as the base case, markets expect Fed to deliver interest rate cuts worth 150 basis points this year. On this, we think markets are contradicting themselves. As the history shows, the Federal Reserve has never cut its policy rate by more than 100 basis points outside a recession, which markets do not expect. The table on display shows our expectations for 2024. We expect global growth to hold up better through early 2024 before slowing significantly later to yield a below-trend growth year overall. Also, we expect inflation to be stickier in the coming months before the disinflation trend resumes. Consequently, growth inflation mix is likely to show slower improvement impeded by the early part of the year. As a result, we expect the Federal Reserve to start cutting interest rates only in the second half of the year. This stands in sharp contrast to market expectations for a rate cut in the first quarter of 2024. This is how we expect a normal year to likely allow investors who are nuanced and nimble to navigate the investment landscape and generate excess returns. Thanks for listening. We hope you found this podcast useful. If you did, please do share this and other episodes with family, friends, and colleagues. For more information on our investment strategies, please reach out to your contact at ADCB. You can also log on to our website at www.adcbam.com. Stay tuned for the next episode of our 2024 Outlook series. This is Kishore Muktinutalapati signing off.